Something extraordinary is happening right now in the global financial system, and most people have absolutely no idea it's even taking place. While the mainstream media focuses on stock market fluctuations and cryptocurrency headlines, a seismic shift in world power is unfolding quietly behind the scenes, and at the center of this transformation is the oldest form of money humanity has ever known. Gold just shattered every record in the books. We're witnessing price levels that would have seemed impossible just a few years ago. But here's what nobody's talking about. This isn't just another bull market rally. This is the physical manifestation of a complete restructuring of the global monetary order. The rules that have governed international finance for over half a century are being rewritten as we speak, and the implications for your wealth, your retirement, and your financial security are absolutely massive. Let me show you exactly what's happening, why it matters more than anything else in the financial world right now, and what you need to understand before it's too late to position yourself properly. Because what we're witnessing isn't just about gold prices going up. It's about the fundamental architecture of global power shifting beneath our feet. Think about this for a moment. When was the last time you saw central banks around the world acting in such perfect unison, all moving in the same direction, all accumulating the same asset with an urgency we haven't seen in generations? These aren't retail investors chasing momentum. These are the most sophisticated financial institutions on the planet, the ones with access to information and analysis that you and I will never see. And they're buying physical gold like their survival depends on it. Because maybe it does. The BRICS nations alone have been accumulating gold at a pace that's frankly staggering. We're talking about tons upon tons of physical metal being pulled out of Western vaults and relocated to the East. Turkey, China, India, Russia, Brazil, these aren't small players making symbolic gestures. These are major economic powers fundamentally restructuring their reserve positions, and they're doing it for a reason. They see something coming that most Western investors are completely blind to. Now, before we go any further, I want to make sure you have access to the information that can actually help you navigate what's coming. I've put together a comprehensive free guide that breaks down the wealth protection strategies that thousands of American retirees are already using to safeguard their hard-earned savings. You'll find it in the description below. It's completely free, no strings attached, just actionable information you can use right now. Let's talk about what's really driving this unprecedented move into gold, because the surface explanation, the one you'll hear on financial news networks, barely scratches the surface. Yes, there's geopolitical tension. Yes, there's inflation concern. Yes, there's uncertainty about interest rates and economic growth. But those are symptoms, not causes. The real story is much deeper and much more consequential. We're witnessing the early stages of de-dollarization, a process that's been building for years, but is now accelerating at a rate that's catching even seasoned analysts off guard. For decades, the US dollar has been the undisputed king of global reserve currencies. If you wanted to buy oil, you needed dollars. If you wanted to settle international trade, you needed dollars. If you wanted to hold safe reserves as a central bank, you held dollars. That system, known as the petrodollar system, has given the United States extraordinary power and privilege on the world stage. But here's the thing about systems built on trust and convention rather than intrinsic value. They only work as long as everyone agrees to keep playing by the rules. And increasingly, major players in the global economy are deciding they don't want to play by those rules anymore. They're looking for alternatives, for ways to conduct international commerce and store value that don't require them to hold massive amounts of US debt or expose themselves to American monetary policy decisions. Enter gold. Gold doesn't care about your politics. It doesn't care about your trade policies or your sanctions regime. It can't be printed into existence by a central bank trying to stimulate an economy or fund government spending. It's been recognized as valuable for thousands of years across every culture and civilization. And most importantly, for central banks looking to diversify away from dollar dependence, it's nobody's liability. When you hold physical gold, you're not trusting in the creditworthiness of any government or the stability of any political system. You're holding an asset that has intrinsic value independent of any institution's promises. This is why we're seeing central bank gold purchases at levels we haven't witnessed since the 1960s, before the Nixon shock ended dollar convertibility to gold. These institutions aren't buying gold because they think it's going to have a nice quarter, or because they're trying to juice their returns. They're buying gold because they're preparing for a world where the dollar's dominance is diminished. where international trade is settled through multiple currencies and mechanisms, where the old certainties of the post-World War II financial order no longer apply. And here's where it gets really interesting. The mechanics of the gold market are such that even relatively modest shifts in central bank buying behavior can have outsized impacts on price. Why? Because the gold market, despite all the paper contracts and derivatives and ETFs, ultimately comes down to physical metal, and there's only so much of it to go around. Annual gold mine production is relatively fixed, around 3,000 tons globally. When central banks start competing for that physical supply, when they're pulling metal out of the market and locking it away in their vaults with no intention of selling, the available supply for everyone else shrinks dramatically. Now layer on top of that the investment demand from individuals and institutions who are watching these central bank moves and drawing their own conclusions. Layer on the industrial demand from technology sectors that need gold for manufacturing. Layer on the jewelry demand from cultures where gold has deep traditional significance. You start to see a supply-demand dynamic that's fundamentally different from almost any other market. But let's dig deeper into what's actually happening on the ground, because the devil is always in the details. When we look at the specific actions being taken by specific countries, a pattern emerges that's impossible to ignore. China, for instance, has been systematically building its gold reserves for years, and many analysts believe the official numbers significantly understate their actual holdings. Why would China do this? Because they understand that in any future where the dollar's role is diminished, gold becomes the ultimate neutral reserve asset, the one thing that every country will accept in settlement. Russia took this strategy even further after facing Western sanctions. They dramatically accelerated their gold accumulation, essentially converting a significant portion of their dollar reserves into physical metal. And here's the crucial point. Those sanctions demonstrated to every other country watching that dollar reserves aren't actually as safe as they thought. If geopolitical tensions can lead to your reserves being frozen or seized, then holding those reserves becomes a strategic vulnerability rather than a source of strength. Gold, stored in your own vaults, doesn't have that vulnerability. India, with its massive population and growing economy, has always had a cultural affinity for gold, but now we're seeing that cultural preference align with strategic reserve policy in ways that are amplifying demand. The Indian central bank has been a consistent buyer, and Indian citizens continue to be among the world's largest consumers of physical gold. When you combine government policy with cultural tradition with growing wealth, you get demand that's not going away regardless of short-term price fluctuations. Turkey presents a fascinating case study. Facing currency instability and inflation challenges, Turkey has been one of the most aggressive central bank buyers of gold in recent years. They understand from painful experience that when your currency is under pressure, when inflation is eroding purchasing power, gold provides a stability that paper currencies simply cannot match. And they're not alone in that realization. Countries around the world that have experienced currency crises, hyperinflation, or economic instability have learned the same lesson. Gold preserves wealth when everything else fails. Now let's talk about the technical side of this market, because what's happening on the charts is just as revealing as what's happening in central bank vaults. Gold has broken through resistance level after resistance level, each time consolidating briefly before pushing higher. This isn't the behavior of a speculative bubble about to pop. This is the behavior of an asset in a sustained bull market driven by fundamental demand. The breakout above previous all-time highs was particularly significant from a technical perspective. For years, gold had been consolidating, building a base, working through the overhead supply from previous peaks. When it finally broke through, it did so with conviction, with volume, with the kind of price action that suggests real money flowing into the market, not just momentum traders chasing a move. And here's what's crucial to understand about this technical setup. We're not in the euphoric blow-off top phase that characterizes the end of bull markets. Retail investor interest in gold, while growing, is still relatively muted compared to the mania we saw in previous peaks. The average person on the street isn't talking about gold at dinner parties. Financial advisors aren't universally recommending gold positions. We're not seeing the kind of speculative excess that typically marks major tops. What we're seeing instead is steady, persistent accumulation by sophisticated buyers who understand the long-term dynamics at play. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been providing its own signals about market dynamics. Historically, when this ratio gets extremely elevated, it suggests silver is undervalued relative to gold and often precedes periods where silver outperforms. We've seen that ratio compress recently as silver has started to catch up to gold's gains, which is exactly what you'd expect in a precious metals bull market driven by monetary concerns rather than just safe haven flows. Speaking of silver, let's not overlook what's happening in that market, because it's equally revealing. Silver has its own supply-demand dynamics that are even more compelling in some ways than gold's. Unlike gold, which is primarily a monetary metal, silver has massive industrial applications. It's essential for solar panels, for electronics, for medical applications, for a whole range of technologies that are only growing in importance. This means silver demand isn't just about investment or central bank buying. It's about the physical needs of a modern industrial economy. And here's the kicker. Silver mine supply has been relatively flat or even declining in recent years. Many of the world's largest silver mines are aging, ore grades are declining, and new discoveries aren't keeping pace with depletion. Meanwhile, industrial demand keeps growing. Investment demand is increasing, and the available above-ground supply is far smaller than most people realize. When you have declining supply meeting rising demand, basic economics tells you what happens to price. The silver market is also much smaller than the gold market in terms of total value, which means it takes less capital to move the price. When investment demand really kicks in, when the broader public starts to wake up to the same dynamics that are driving gold higher, silver has the potential to move even more dramatically. We've seen this pattern play out before in previous precious metals bull markets, where silver initially lags gold, but then catches up with explosive moves that dwarf gold's percentage gains. Now, I want to address something that's critically important for anyone thinking about their financial future, especially if you're approaching retirement or already retired. The traditional portfolio allocation models that financial advisors have been using for decades, the 60-40 stock-bond mix, the modern portfolio theory approach, all of that was built for a different world. It was built for a world where inflation was under control, where interest rates followed predictable cycles, where the dollar's dominance was unquestioned, where geopolitical stability was more or less assumed. That world is gone. We're in a new paradigm now, one where the old rules don't necessarily apply, where the old safe havens might not be so safe, where the correlations that portfolio managers relied on are breaking down. In this new world, having a portion of your wealth in physical assets that can't be printed, that don't depend on any institution's solvency, that have held value across millennia, that's not speculation. That's prudent risk management. And here's where I want to mention something that might be relevant to your situation. If you're sitting on retirement accounts with significant balances, if you have IRAs or 401ks that represent decades of savings and hard work, you have options that many people don't know about. Gold IRAs allow you to hold physical precious metals within a tax-advantaged retirement account, giving you the wealth preservation benefits of gold while maintaining the tax treatment of your retirement savings. I've put together a detailed guide on how this works, the rules you need to know, the potential benefits and considerations. You'll find it in the description. If you have over $100,000 in retirement accounts, this is definitely worth understanding, especially given everything we're seeing in the broader financial system. The thing is, we're not just talking about protecting against inflation or hedging against stock market volatility, though gold certainly does both of those things. We're talking about protecting against systemic risk, against the possibility that the financial system itself undergoes fundamental changes that could impact the value and accessibility of conventional assets. When central banks are buying gold at record rates, when major economies are actively working to reduce their dollar dependence, when the geopolitical landscape is shifting in ways that challenge the post-war order, having some portion of your wealth in an asset that sits outside that system isn't paranoia. It's common sense. Let me give you a historical parallel that might help put this in perspective. In the 1970s, after Nixon closed the gold window and ended dollar convertibility to gold, we entered a period of massive monetary uncertainty. Inflation soared, the dollar weakened, traditional investments struggled, and gold went from $35 an ounce to over $800 an ounce in less than a decade. The people who recognized what was happening early, who understood that the monetary system was fundamentally changing, who positioned themselves accordingly, they didn't just preserve their wealth, they multiplied it many times over. Now, I'm not saying we're going to see the exact same pattern repeat. History doesn't repeat, it rhymes. But the underlying dynamics, the loss of confidence in fiat currency, the search for alternatives, the recognition that the old monetary order is breaking down, those dynamics are remarkably similar. And just like in the 70s, the people who recognize what's happening early, who take action before the crowd, are going to be in a fundamentally different position than those who wait until the trend is obvious to everyone. The challenge is that by the time something becomes obvious to everyone, by the time it's being discussed on mainstream financial news, by the time your neighbor is talking about it, most of the move has already happened. The real money, the generational wealth building opportunities, those come from recognizing major trends before their consensus, from having the courage to act on your analysis even when it feels uncomfortable, even when it goes against conventional wisdom. And make no mistake, buying gold right now at what many people perceive as high prices feels uncomfortable. It goes against the ingrained instinct to buy low and sell high. But here's what you need to understand. In a genuine paradigm shift, in a real structural bull market driven by fundamental changes in the global system, what looks expensive today will look cheap in hindsight. The people who bought gold at $400 thought they were buying high. The people who bought at $800 thought they were buying high. The people who bought at $1,200 thought they were buying high. And yet, from today's vantage point, all of those prices look like incredible opportunities. The question you have to ask yourself is whether we're in one of those paradigm shift moments. And to answer that question, you have to look at the evidence objectively. You have to look at what central banks are doing, not what they're saying. You have to look at the structural changes in the global economy, the rise of alternative payment systems, the development of bilateral trade agreements that bypass the dollar, the growing network of currency swap lines between countries that want to reduce their dollar dependence. You have to look at the fiscal situation in the United States and other Western nations, the massive debt loads that can only be serviced through continued monetary expansion, the political impossibility of the kind of austerity that would actually address those debt burdens. You have to look at the demographic trends, the aging populations in developed nations that will strain social safety nets and pension systems. You have to look at the geopolitical tensions, the fracturing of the post-Cold War consensus, the emergence of a multipolar world where American hegemony is increasingly challenged. When you look at all of that evidence together, when you step back and see the big picture, the case for gold becomes overwhelming. This isn't about short-term trading or trying to time the market perfectly. This is about recognizing a multi-year, possibly multi-decade trend and positioning yourself to benefit from it. This is about understanding that we're in the early innings of a major transformation in how the global financial system operates, and that transformation is going to create winners and losers on a massive scale. The winners will be those who hold real assets, who have positioned themselves outside the system that's being transformed, who have protected their wealth in forms that don't depend on the promises of governments or the stability of fiat currencies. The losers will be those who remained fully invested in the old system, who trusted that the institutions and mechanisms that worked for the past 50 years would continue to work indefinitely, who failed to recognize that change was coming until it was too late to adapt. Now let's talk about the mechanics of how this plays out, because understanding the mechanism is crucial to understanding why this trend has so much further to run. The global financial system is built on layers of debt and leverage. Governments owe money to bondholders. Banks owe money to depositors. Corporations owe money to creditors. All of this debt is denominated in currencies that can be printed by central banks. And when the debt burden becomes too large to service through normal economic growth and tax revenue, the only politically feasible solution is to inflate it away. That's not a conspiracy theory. That's not doom and gloom speculation. That's basic economics and political reality. No government in history has ever voluntarily chosen to default on its debts when it had the option to print money instead. And no government has ever chosen austerity and deflation when it had the option to inflate. The path of least resistance, the path that's politically palatable, is always to print more money, to keep the system going, to kick the can down the road. But here's the thing about inflation. It's a hidden tax on everyone who holds currency or currency-denominated assets. It transfers wealth from savers to debtors, from the prudent to the profligate, from those who played by the rules to those who leveraged themselves to the hilt. And people are starting to figure this out. they're starting to understand that the purchasing power of their savings is being eroded, that the promises made about retirement and Social Security might not be worth what they thought, that they need to protect themselves. This is where gold comes in. Gold is the ultimate inflation hedge, not because its price goes up in nominal terms, though it does, but because it maintains its purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago or 1,000 years ago. The same cannot be said for any fiat currency in history. Every single one has eventually lost most or all of its value. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created, and that process is accelerating. The smart money understands this. That's why central banks are buying. That's why billionaires and family offices are allocating significant portions of their portfolios to physical gold. That's why countries are repatriating their gold from foreign vaults, wanting physical possession rather than just paper claims. They see what's coming, and they're preparing for it. And here's something that doesn't get talked about enough: the paper gold market versus the physical gold market. There are far more claims on gold in the form of futures contracts and unallocated accounts and ETF shares than there is actual physical gold to back those claims. This works fine as long as everyone doesn't try to take delivery at the same time. But if confidence in the paper system breaks down, if people start demanding physical metal instead of accepting paper promises, the price discovery mechanism could break in spectacular fashion. We've already seen hints of this in recent years, with periodic shortages of physical gold coins and bars even as the paper price remained relatively stable. We've seen premiums for physical metals spike well above the spot price, indicating that the real market for actual gold is tighter than the futures market suggests. If this dynamic accelerates, if we see a real rush for physical metal, the price could move in ways that shock even seasoned precious metals investors. This is why taking action now, while physical metal is still readily available, while premiums are reasonable, while you can still get size without moving the market, this is why that matters. Because if you wait until everyone else has figured it out, until the shortage is obvious, until premiums are through the roof and dealers are rationing supply, you'll be competing with millions of other people who all had the same realization at the same time. Think about what happened with toilet paper at the start of the pandemic. There was no actual shortage of toilet paper production capacity. But when everyone tried to buy at once, when panic set in, the shelves went empty and stayed empty for weeks. Now imagine that dynamic playing out in a market where the underlying supply is actually constrained, where production can't be ramped up quickly, where the smart money has been accumulating for years. That's the potential scenario we're looking at with physical precious metals. The geopolitical dimension of all this cannot be overstated. We're watching the emergence of alternative power centers that are explicitly working to create systems that operate outside of Western control. The BRICS nations aren't just talking about creating alternative payment systems and reserve currencies, they're actually building them. They're establishing development banks, creating currency swap arrangements, settling trade in their own currencies, and backing it all with gold. This isn't happening in secret. This is all public information, but it's not being widely reported or discussed in Western media, and most investors aren't paying attention. They're still operating under the assumption that the dollar will remain dominant indefinitely, that the current system is permanent, that nothing fundamental is changing. That assumption is going to prove very costly for those who hold it. The sanctions regime that the West has deployed against Russia and other countries has had an unintended consequence. It's accelerated the development of alternative systems. When you demonstrate to the world that dollar reserves can be frozen, that SWIFT access can be cut off, that the financial system can be weaponized for political purposes, you give every other country a powerful incentive to develop alternatives. And that's exactly what's happening. China and Russia are settling trade in their own currencies. India is buying Russian oil in rupees. Saudi Arabia is discussing oil sales in yuan. These aren't just symbolic gestures. These are concrete steps toward a world where the dollar is one option among many, rather than the only option. And in that world, the value proposition of the dollar changes fundamentally.